Looking at the markets right now, we've made a pretty big recovery from the lows. In the S&P, as of this recording, we're up over 17%, and now we're bumping up right against this 200-day moving average. So a question I've been getting a lot is this bear market over? Well, of course, I wish I had the answer to that question. This has obviously been a pretty good run, and this is probably the best we've felt all year, right, with this market. But we gotta keep in mind that this may just be a bear market rally. Take a look at this chart from Ben Carlson. He posted about the 2000 to 2002 bear market. You can see how many big rallies we had during this 2-year period. Up 19%, 21%, 21%, 21%, all while falling right after. And you're hitting these lower lows over a longer period of time. So if you remember, we were talking about on the shorter time frame when we were watching this market come back up, we were looking for higher lows. And we kind of saw those get put in right around here, right? But this is all still very short term, because what could happen right here, and around the 200-day moving average is a great time for it to happen, because what could happen now that we're hitting this 200-day moving average would be a great time for the market to just turn around and go lower and lower until it makes a lower low. And that would be what? On a longer time frame, right? Markets are fractal. So for shorter term traders, this was a bull market right here. For longer term traders, this just might be a small rally in the face of a larger bear market. It is very difficult to know though. And at the same time, in hindsight, it's going to seem so obvious, but it's never obvious when you're in the middle of it. And that's why we always talk about managing your risk on this channel, because that's the only thing you can really do. Manage your risk, and I guess manage your psychology too. Those things kind of go hand in hand though in my book. Ben also posted some thoughts on the economy that we could go over. So part of the reason this rally really got boosted is because inflation was basically flat from June to July. So this is kind of the first good news that we've gotten in a while on the inflation front. And you can see here the energy components really softened. And you probably saw that at the pump. Gas is still expensive, but $4 a gallon is much cheaper than $5 a gallon. So oil prices softening and gas prices going down, that helped a lot. Now, of course, inflation of 8.5% over the past 12 months is still very high, because June to July is just month over month, right? Inflation compared to last year is still very high. But that's going to take a while to subside, even if prices do continue to slow down, because we're comparing to a year ago. Now, obviously, one data point does not make a trend, but it does seem like the Fed's moves, along with some easing of the supply chains, have helped stop the uninterrupted rise in prices. Gas prices are down like 60 days in a row, oil prices are down, used car prices are finally falling. So this could be the start of a trend, but we really won't know until we get some more data, right? Now, a big reason the market was able to rally, and the market is smart, so it knows this is not a trend just yet, is because the market works off of expectations. So if the market was expecting all these numbers to be higher and they came in lower, then what are you going to get? You're going to get a rally. And that's what we mean when we talk about the peak inflation narrative. So when everyone thinks inflation is going to be so bad and it comes in not as bad, that's good news. And the market is going to correct based off that. So what we're looking for here when we're watching the inflation numbers going forward is not so much of it getting completely solved right now, but you don't want it getting worse than what people thought it would be. So again, it's never about the actual number when it comes to markets. It's just what the number is versus what people expected. It's all relative. Now, we don't know what the Fed is going to do without knowing what inflation data is going to look like in the coming months. But we know they have said recently that they're going to do everything they can to tamper down inflation, even if it means spiking the job market. They will put us into a recession if it means bringing down the inflation rate. So Minneapolis Federal Reserve Bank President Neil Kashkari, he said he's sticking to his view that the U.S. Central Bank will need to raise its policy rate another 1.5 percentage points this year and more in 2023, even if that causes a recession, like I just said. He said the Fed is far away from declaring victory on inflation, despite the welcome news that we've had from recent data. He said he hasn't seen anything that changes the need to raise the Fed's policy rate by 3.9% by year end and to 4.4% by the end of 2023. Current rate is around 2.25 to 2.5. Again, this is all fine as long as it's in line with what the market is expecting, which is why we play that stupid game with the Federal Reserve. It's like, what do we think is going to happen and what are you going to do? And are you signaling enough so that we know what's going to happen and aren't surprised? Because if we're surprised, that's when the market starts to go down. Now, the Fed definitely cares more about inflation than the job market right now. That's their dual mandate, right? Control inflation while still having low unemployment. So they're going to likely keep raising until, they can tamper down on that inflation. Now, if we had to imagine what a soft landing would be like, well, currently our unemployment rate is around 3.5%. So if we could raise interest rates to tamper down inflation, obviously, according to the math, the unemployment rate should go up, right? Not to say that's absolutely going to happen, but if the unemployment rate goes up but stays under 5%, that would be be great if we could get inflation back to 3% or so. Now this sounds unlikely, but there are currently more jobs available than people who are looking for jobs. It is a really good labor market. So job openings are at 10.7 million right now, so the dream soft landing scenario for the Fed would to see these openings fall by 4 to 5 million. But at the same time, the unemployment rate doesn't go much above 4 to 5%, just because so many people, I guess, aren't looking for work. And what could be interesting about this coming recession is if employers hang on to most of their employees. And that seems to be what they're doing, because during the pandemic, they had to lay off so many people. But this time around, because they knew how hard it was to recruit talent over the past 2 years after they laid them off, they would rather just hang on to their employees, even if it comes with carrying costs. So it would be easier for these companies to hang on to workers during a slowdown or recession if they expect the downturn to be brief and shallow. Because millions of people were either let go or put on shelf in 2020, right? And that made it way more difficult to restaff once demand came back faster than the companies were used to. So they don't want to go through that again. So what if employers end up holding on to more employees than in past recessions, because they assume this next one will be mild? And what if companies don't want to go through that whole hiring process all over again? That could be what's happening, which is why the labor market may remain tight. So then where will markets go from here? Well, if inflation keeps improving and there isn't some outside shock to the system, we could see new highs by 2023. But the risk of a Fed policy error has probably never been higher, so it wouldn't be surprising to see more volatility in the months ahead either. Like we talked about before, if this was the bottom in the market, it will be very obvious in hindsight. But if the market rolls over from here, it will also be very obvious in hindsight. That's why it's kind of a fool's errand to try and predict where the market is going to go. You just got to manage your risk and your emotions. Also, in other news, Alex is back, so we'll get back into the macro research on this channel, but we're not going to stop the personal finance and psychology either. And if you haven't watched our last video on why you're actually probably wasting your money, you should definitely go check it out. It was really popular and we got a lot of great comments on it. So click this video right here and I will see you there.